This strategy is all about taking advantage of trends, but instead of chasing the trend, the key here is to enter during a pullback of that trend. This way, when the trend continues, you'll end up with way more profits because you entered with a better risk to reward. So, here's how the strategy works. Step 1 is to first identify the direction of the current trend. Is it an uptrend or a downtrend? The easiest way to do this is by using an indicator like the 50-period exponential moving average, or the 50 EMA for short. To identify the trend using this indicator, we simply look at the direction of the indicator and the position of the price. So, if the EMA is sloping upwards, like this, and price is above it, then it's a clear uptrend, which means for this setup, we'll wait for a pullback downwards to enter a long position. Now, if the EMA is sloping downwards and then price is below it, then it's a clear downtrend, which means we'll wait for a pullback upwards to enter a short position. Now, the obvious question is, how do we know the exact spot where price will make a pullback? This brings us to the second step. Look for something called a fair value gap. For those who don't know, a fair value gap is a setup where the high of the first candle and the low of the third candle don't overlap with the middle candle's body. This creates a visible gap called a fair value gap. So remember, if there's no gap, then it's not a fair value gap. Now, why does this matter? It's because when a fair value gap forms on a chart, price usually has a high chance of pulling back into it, almost like a magnet. Most of the time, it'll retest the gap and bounce off it, continuing the direction of the original trend. And it's during this pullback is where we'll enter our position. One thing to remember is, for a fair value gap to be considered valid, it needs to be large. The larger the gap, the higher the chance that the setup actually plays out. If the gap is too small, there's a high chance the setup could fail, so it's best to avoid trading it. Now let's implement this in a real example. Again, the first step is to identify the current trend. In this case, we can see that initially, price was in a downtrend, as shown by it staying below the 50 EMA. Then, price crosses above it, signaling a shift into an uptrend, which means we're now looking for a pullback to buy into this current uptrend. The next step is to look for a fair value gap, and right here, we spot a large green candle, where the high of the previous candle doesn't overlap the low of the next candle, creating a fair value gap. The size of the gap is also quite large, which makes it valid for entry. The next step is to be patient and wait for the price to pull back into the gap. But we also want to make sure that the uptrend structure remains intact and that the pullback isn't too deep. In this example, price eventually pulls back into the gap. Now, ideally, we also want to see some confluences here, which simply means that there must be other factors confirming the setup besides the fair value gap alone. In this case, we can see that price is also sitting on the 50 EMA, acting as a support level. This gives us extra confirmation that it will likely bounce from this area. From here, we can enter a long trade, with our stop loss placed just below the fair value gap and our take profit set at 3 times the risk. As you can see, price bounces perfectly and hits our take profit target. Let's look at another example. Here, we can see that the 50 EMA is sloping downwards, and the price stays below it, making this a clear downtrend. This means we're now looking for a pullback upwards to enter a short position. Next, we can spot a bearish fair value gap from this large red candle, where the previous candle's low doesn't overlap with the next candle's high. Once the fair value gap is identified, the next step is to wait for price to make a pullback and fill the gap, ideally with confluence. In this case, price retraces into the fair value gap while also touching the 50 EMA. From here, we can place a short position with our stop loss slightly above the fair value gap and our take profit set at 3 times the risk. And as you can see, price drops perfectly and hits our take profit target.